There's a number that got released this week that's going to decide whether your savings account, your mortgage, and your stock portfolio all move in the same direction for the next 6 months. Most people are never going to see it because it's buried inside a press release. That sounds incredibly boring. Fed holds rates steady. That headline put half the country to sleep. But underneath that boring headline is something that should make you sit up. A man who was handpicked by the president to cut rates, to make your mortgage cheaper, your savings flow easier, just walked into his first meeting as Fed chair and did the opposite. 9 of the 18 people in that room are now telling you a rate hike is coming. Not a cut, a hike. I'm going to show you that exact number in a few minutes, and once you see it, you'll understand why Wall Street reacted to what looked like nothing happening, as if something big just did. If you have savings, a mortgage, a credit card balance, or money in the stock market, and let's be honest, that's basically everyone watching this. What happened in that room on Wednesday is the blueprint for the next 6 months of your financial life. Stick with me because by the end of this video, you'll know exactly what to do about it. Let's get the facts straight first, because this is where most coverage gets lazy. On June 17, 2026, the Federal Reserve voted 12-0, unanimous, to hold the federal funds rate at 3.50% to 3.75%. That's the 4th meeting in a row with no change. This was Kevin Warsh's very first meeting as Fed chair. He was confirmed by the Senate just over a month earlier after being nominated specifically because the administration wanted someone who would lean toward cutting rates and easing pressure on borrowers. Here's the detail nobody's talking about enough. In April, under the previous chair, that vote was split 8-4. Under Warsh, it was perfectly unanimous. That's not normal. New Fed chairs almost always want to show the market they're serious, that they won't be pushed around, even by the president who appointed them. Warsh just proved that in his first 15 minutes on the job. The rate hold itself wasn't the surprise. Markets had already priced in a 97% chance of exactly this. The surprise was everything around it. Every quarter, the Fed releases something called the dot plot. Basically 18 anonymous predictions from committee members about where they think rates will be by year end. In March, the median prediction was 3.4%, which, if you do the math, implied at least one more rate cut this year. In June, that number jumped to 3.8%. That's not a small move. That's the entire committee flipping its stance from we're easing to we might need to tighten. 9 of the 18 members now see at least one hike before the year ends. 6 of those 9 think we'll need 2 hikes. A few months ago, almost nobody on that committee was talking this way. And here's the detail that should genuinely intrigue you. Kevin Warsh, the new chair, didn't submit a dot at all. He abstained. The man steering the ship didn't show his own hand. Maybe that's strategic. Maybe he genuinely doesn't know yet. Either way, it tells you this committee is more divided and more uncertain than the calm press conference let on. So, why the sudden hawkish turn? Follow the data with me. May's inflation report came in at 4.2%, a multi-year high. Wholesale prices, the PPI, came in even hotter at 6.5%. And the May jobs report blew past expectations with 172,000 new positions, meaning the labor market isn't slowing down the way the Fed needs it to if it wants to justify cutting. The Fed also revised its own forecasts. Inflation expectations for 2026 jumped from 2.7% to 3.6%. Growth got trimmed slightly down to 2.2%. Unemployment ticked down to 4.3%, meaning the labor market is actually too strong for comfort from an inflation fighting standpoint. Simply, prices are rising faster than expected, jobs are holding up better than expected, and that combination leaves the Fed very little room to justify cutting rates, even if the president wants them to. One more thing worth noticing, because it tells you who Warsh is as a leader. His statement was just 130 words, compared to the 300+ word statements we'd gotten used to under the last chair. He stripped out forward guidance completely. No more hinting at what's coming next. In his own words, the commitment to 2% inflation needs to be strong, unanimous, and unambiguous. Something he said the Fed has missed for 5 years. Translation: Less hand-holding, more data watching. You're not going to get easy hints from the Fed anymore. You're going to have to read the data yourself, which is exactly why this channel exists. Now, before you panic and assume rate hikes are locked in, here's the twist that could break this entire hawkish narrative. Just as the Fed was turning hawkish, oil prices were collapsing. A peace deal tied to the Iran conflict pushed crude down from nearly $98 a barrel to under $79. If that holds, July's inflation report could look dramatically different from May's, potentially dropping toward 2.5% to 3%. If that happens, this hawkish dot plot starts looking premature, maybe even wrong. Half the committee built their hike case on inflation data that might be about to reverse itself for reasons that have nothing to do with the Fed's own policy. This is the trap. Don't build your financial plan around what the Fed says it will do. Build it around what's likely to actually happen, and right now, that's genuinely uncertain. Markets didn't love the hawkish surprise. The S&P 500 dropped about 0.6%, the Nasdaq fell 0.7%, and the 2-year Treasury yield, which reacts fast to rate expectations, jumped to over 4.15%. Stocks clawed back some ground the next day as investors digested it, helped by that same oil-driven optimism. Here's what actually matters. What do you do with this information? 1. Your savings. If rates stay higher for longer, your high-yield savings accounts, CDs, and treasury bills remain genuinely attractive. Don't rush to lock in lower long-term rates just yet. There's no rush for the Fed to cut, so there's no rush for you to abandon cash yield. 2. Your debt. If you're carrying credit card or variable rate debt, don't bank on relief this year. Prioritize paying it down aggressively now, rather than waiting for rates to drop and bail you out. 3. Your investments. Rate-sensitive sectors, small caps, real estate, high-growth tech could face more pressure if hikes actually materialize. This doesn't mean panic sell. It means know what you own and why you own it. 4. Watch oil, not just the Fed. The next CPI print, driven heavily by where oil settles, may matter more for your financial decisions over the next 2 months than anything Warsh says in a press conference. The real lesson from this meeting isn't rates are going up or rates are going down. It's that the Fed itself doesn't fully know yet, and neither does anyone telling you with total confidence what happens next. Build a plan that survives either path. The Fed just handed you more questions than answers, and that's exactly when it pays to be paying attention. If this broke down what the headlines didn't, subscribe, because we'll be tracking that July CPI print the moment it drops, and it might just blow up everything the Fed thinks it knows right now. If this video helped you cut through the noise, like it, share it with someone who's sitting on cash wondering what to do. See you.